So good evening, everybody. Thank you for spending some time with us again tonight, today, wherever you are in the world. Tonight, we've got a wonderful product or two to share with you, and quite different, perhaps for different extremes into your portfolio. We'll run through these now. It'd be wonderful to get a bit of background from Andrew in terms of how these fit into the world today. And without further ado, so tonight we're going to chat about the Natixis launch, a 3-year triple index fixed income product, and Societe Generale's low hurdle. This is a growth-based note, but doing something slightly different. Jill put me under strict instructions to remind everybody, Cashbox Global is an authorized and regulated FSC in Mauritius, as well as in South Africa. We are in the space of designing product and offering education and information around that product. We aren't in the space and can't be in the space to offer any advice. If you need to, please do your own due diligence. And if you'd like to take this to your advisor, that's wonderful. And if your advisor would like to chat to us, that's also perfectly acceptable. We look forward to that chat. There we go. So, Andrew, I'm going to hand over to you. I think we'll tee off with the fixed income note. Available, I see, both in pound and dollar.
So I think it sort of speaks to itself or from itself in terms of what it's doing. It's and Chad will go through it. It's a 3-year. It's triple index, so there's 3 underlying indices in the reference basket, and it's a fixed income. And as Chad mentioned, available both in pounds and US dollars, paid quarterly. And those rates are not perhaps what you sometimes expect from fixed income, but often fixed income is 4 to 5 years. This is a 3-year, so it's quite a short period. And just to sort of let you in on how these things work, the shorter the period, the less the coupon that's presented. In other words, the bank shaves the coupon quite aggressively the shorter the term. So, you start getting down to, let's say, we've had clients ask for a 1-year or 2-year sort of fixed income, and then you're almost coming in line with fixed deposits and cash and stuff like that. So it's one of these games that we have to sort of get the right tipping level. Closing date 3rd of March. Just to run through it briefly, Natixis, and I think, Chad, it's actually on the next slide. It's a very large. Okay, well, there we go. Let's just run through it. So it's fixed income. It pays a guaranteed coupon every quarter, so that per annum is just divided up by 4. It's not dependent on the performance. It pays irrespective of what those underlying indices are doing, whether they're up or down, sideways, etc. It pays. It's like a fixed term deposit. It's a contract. It pays out. The fixed term is 3 years. It could actually mature early, and the relevance of the coupon is important because we'll show you a slide relative to what you're getting in cash or fixed term deposits, etc. And that's a huge variable, but we have got the opportunity to actually mature early. So the indices we've chosen are 3 geographic areas. One is Europe, one is America, and one is Japan. And we won't flip to it right away, but those indices have performed in a pretty exemplary fashion, given that, specifically we've had very, very high interest rates for the last three years. And that's obviously a bit of a downer. It's a bit of it's a depressant on companies' earnings, etc. Companies that may be carrying debt, consumerism just sort of don't put their hand in their pocket, they close the wallets. And many of these companies are dependent on earnings, and hence their valuations are driven by earnings and profits, specifically profits. So we've got 50 of the largest capitalized companies spread around Europe. And when I say Europe, I mean generally Western Europe, not Eastern Europe. The Russell 2000 is a far wider bellwether sort of indicator than, let's say, the S&P. The S&P is 500, so it's the 500 biggest companies. This is much more representative of, I would suggest, mid-capitalized companies in the US. And it covers far more indices, far more sectors, far more industries. So it's more of a sort of not working man's level, but it's more of a working index in terms of it shows where it really is happening at grassroots level. Okay, the Nikkei 225, and these are all very long established sort of blue chip indices, if you want to call them that. The Nikkei 225, again 225 of the largest capitalized companies in the Japanese market. So typically, you'd find Toyota there, you'd find Canon, Nikon, typically all the big household names, mainly fast-moving consumer goods, etc. So, and they've all got very, very similar type of, if I can call it in a very technical word, a stochastic. If we go to the next slide, and what I mean by stochastic is how they've performed over the last, and I think it's actually is it not on a slide, Chad, after this?
Yes, it's coming up.
Yeah, it's coming up. Okay, so so a stochastic is really just where the line moves in terms of a chart, and we'll get to that. So this is what I was referring to a little earlier. If we go really, really short and we try and ask for a 1 year or 2 year from the bank, they say, well, just give us your money on deposit. So we're trying to squeeze a little bit more alpha, a little bit more return, pay for you. And for that, we've got to obviously give something up and we take something in return. So just as a comparative, we decided to look at what cash is giving you. Okay, and obviously at the moment, cash is, well, in Europe, it's coming down. In the UK, it's coming down, cash rates, because it's linked to the interest rate cycle. And those interest rate cycles are definitely moving downwards. The US is sticky. It's sort of stuck in a sort of a holding pattern at the moment. And I can address that perhaps a little bit more when we talk about the banks, the next note, which is relative to banks. But at the moment, if you look at it, it depends on location. I was saying to somebody, if you invest if you're working in Dubai, for example, and you are a resident there, you're being paid by a Dubai-based company, and let's say you're at HSBC, you'll get a completely different rate to somebody working, being paid for and banking at HSBC London or BVI, etc. So location is quite important. The duration, obviously, the term of how long you put your money there, fixed deposit, if it's 30 days, 60 days, 90 days, etc. But cash is very fluid and rates are very fluid as well. So you're not getting a great deal. So cash, I mean, if you've got it on your current account or call account, you're getting peanuts. You're still getting peanuts. You've had peanuts for a long time, and maybe the banks see us as monkeys. But fixed term deposits are perhaps a little bit more where we squeeze out something of the banks. And then it depends as well. You can see the rates there. I've used two, Jules, in fact, overseas at the moment in Africa and Kenya, doing a presentation to African-based, Kenyan-based clients, and they're very focused on cash. Cash in Africa moves very quickly. And those two companies, Standard Chartered and HSBC, have a huge presence in Africa. So we use those particular rates. But it also depends. To attract some of those interests, you've got to put in $100,000, $50,000. I know, for example, Societe Generale, who we use a lot in our notes to underwrite the notes. A client of mine said he had to come up with $250,000 in Europe to attract that type of interest rate. So it is not all equal in love and war, apples and horses for courses. It is quite tricky to work out is there one rate? No, there's not one rate. But if you look at the type of returns you're getting there on a fixed term, you're getting 3.5% to 4%. We're keeping in the background the fact that we've underwritten through Natixis 7% in dollars and a 6.5, 6 and a bit in sterling. And a 3 year fix, we wanted to look at, well, try and compare apples with apples. So a 3 year fixed term deposit is around 4.6%, a little bit of an averaging there. As I said, rate depends on bank, amount of money, and perhaps location. The difference being is that with a note versus a fixed term deposit effectively you've got to worry about, in terms of risk security, you cannot get your funds, it's fixed for 3 years, so your funds are in there, and is the risk of the counterparty bank acceptable to you? Is it palatable? Is it a good bank that you're putting your funds with? So we always say, one has to do your due diligence. You have to do your interrogation of like, who are you giving your money to? Because effectively, they need to be compliant in terms of your own, interrogation of them. Whereas a note, obviously, we always go for a tier 1 investment bank, A-rated through the credit rating agencies. But to get that enhanced coupon of 7% in this instance, we have to say, well, we have to give something up. And giving something up is that we say, well, at any stage at the end of the term, okay, so during the term, 3 years, it's happy days. You're making 7% per annum. So it's great for guys who want a fixed, predetermined, I know I can factor 7% into my CapEx timeline for 3 years, for 36 months. But at the end of the period, those banks need to have maintained their balance sheet above 50% of what they started at. In other words, we've built in that deep capital protection of 50%. So in this instance, with those indices, because that's the reference basket, Natixis we're comfortable with, they're going to be around. Natixis is part of BPCE, which is the 3rd or 4th largest banking group in France. I think they're just shy of 900 billion euros assets under administration. So a very, very large French bank. They're systemically important. But the 3 reference baskets, and Chad will talk you through it, if any one of those has dropped below the capital protection barrier, then capital is risk. So that differentiates a fixed term deposit in this instance in terms of security and risk from perhaps a note. And that's a thread that runs through, structured notes as an asset class, if you want to call it that. There's the terms in terms of what it's all about. I pretty much run through most of these 3 years. It's guaranteed, so it's not dependent on their behavior. It's only their capital protection that is dependent at the end of term. We've touched on the 3 reference indices. Availability, we've got it now, and it runs until 3rd of March in terms of availability. Our normal 10,000 is available. I think, Chad, if you want to add anything in from there, you can.
Yeah, no, cool, Andrew, thank you. I think you've covered everything nicely. If anybody is interested and would like to reach out, just let us know. The email address is support@cashbox.global. I'd also invite anybody that has any questions to drop it in the chat group, or we'll open up for Q&A at the end. So if there's anything in this that you don't understand and you'd like to ask a question, please feel free. It's great when it's interactive. The next sheet is one of our favorite. Of course, it's the observation dates, and in this case, the payment dates. While we go through observation dates, there's no need to observe where the underlying assets are. In this case, it's a fixed income, pays out irrespective. So paid to your trading account on the 13th of June would be a quarter of what you saw as the annual rate, of course, and it would pay out regularly on these dates, which makes a structured note wonderful because within 3 months, it's already starting to produce for us, and in this case, a fixed income. Now, what we have, sorry, just to move stuff out the way, what we have is the very last observation will take place when the product gets to March 2028. On this date, we need to make sure that our underlyings have not dropped by more than 35%, because as you know from the capital protection barrier, our capital is protected right the way down to 65% of the start price, a level of insurance, if you like, on the product, which is wonderful with these fixed income. So again, as Andrew said, who you're dealing with in terms of the bank, are you comfortable to loan them the money for this period of time against your contract? And are you also comfortable that by the end of the term, these underlying indexes would not have dropped by more than 35%? And my understanding is a market crash would be an index dropping at 20%. So just give you a level of the depth of protection that's built into this. So Andrew, I think a wonderful product for the community that's looking for fixed income. Thank you for that. Did you want to chat through this back testing and index performance, Andrew? Was that what you were referring to?
Yeah, thanks. I thought I'd actually, earlier on when I saw the presentation, I thought I'd moved it earlier
Okay.
But yeah, so there you go. When I was talking about a stochastic, it's really just a line that follows the performance of an index or a stock or a market or everything. And you can see these are developed markets. They're mature markets. They've been going a long, long time, way back beyond 2013 in terms of the slide. But what we do here with our structure is we do some back testing in terms of would it have tested those levels that Chad spoke about in terms of capital protection. As we point out, this is an alternative to cash. You fix, you lock in, especially in an environment of falling interest rates. Particularly in this instance, the States are a bit sticky, but sterling is going down, and certainly the euros are. So you can see probably the biggest dip is just to the right of the middle of this chart, 2020, and we all know what happened there. That was the start of COVID and the great lockdown and how our lives all changed forever after. But effectively, even though with high interest rates and headwinds of global geopolitical tensions that we've had in the last year or two, particularly Middle East and Eastern Europe, and those tensions haven't gone away. There's bright sparks or green shoots, whatever you want to call them. Hopefully things can get resolved, but there's other sort of flashpoints around the world that may pop their head up, whether it be China, whether it be Taiwan, etc. But these markets are developed markets, so they don't act like perhaps an emerging market, which would be far more radical in terms of its performance matrix. So yes, they've done particularly well, even though high interest rates, and many companies have been carrying debt. But as a sector, so we're not focused on 4 companies or 3 companies or 5 companies. This is a wide sector, or sectors, and right across the 3 major areas: Euroland, America, and Japan. These are major manufacturing sort of production areas in terms of product that they push out to the world in these high interest rate levels. And if markets are falling, the expectation from analysts is that, and I'm talking about probably 36 of the top major Wall Street analysts, is that earnings for most companies across these indices that are reflected here are probably not going to be as stellar as we perhaps saw last year, because everybody was excited about interest rates falling. The mood has now been tempered a little bit in terms of, okay, we're not going to have 5 cuts in the US. I think they're factoring in maybe 2 now. So reality is sort of setting in with the new administration and all sorts of other things. But what that will mean is that if rates do not come down as rapidly as one would hope, probably earnings will be a little bit more muted, still profitable. And that's all we need. As Chad mentioned, we just need for capital protection in 36 months' time, is that these indices have not gone down by more than 35%. And as he rightly mentioned, when you talk about a 20% drop, that you start talking about the dreaded word market crash. And we haven't experienced 35% loss. So we're quite comfortable in terms of having chosen these particular areas. They're actually quite different in terms of their performance as well. I mean, Euroland, particularly the UK and Euroland, has been very stagnant. Their economy is stagnant. That's why there's been aggressive that's why there's been aggressive interest rate cuts. And it's pretty predictable, and they're sticking to their narrative. The Russell 2000, in as much as they've had a couple of cuts, they're only 75 basis points off their high, but still the American economy is pretty resilient. And in fact, things seem as though they could be turning the other way with inflation. I mean, the inflation figures that came out yesterday, coming out today, a little bit more hot than they were expecting. And it allowed Jerome Powell at a Senate congressional hearing yesterday to actually say, well, this gives them more comfort in terms of not rushing to cut further rates, every sort of 2 months or whatever it is. There's no interest rate. There's no Federal Reserve meeting in February. The next one's in March. And that's pretty much been discounted that there's going to be a cut in March. So that's the sort of feeling, the consensus amongst big banks and analysts at the moment. So they're just watching and waiting to see. America has proved very resilient. And if we move to Japan, Japan has been, for many, many years, sort of negative interest rates. Really it's been quite problematic, but their market has moved, quite solidly. In terms of, there was a little bit of a blip last year, mid of the year, when the Bank of Japan suddenly, without notice to anybody, decided to put up the interest rates, and you see the yellow line right towards the far right-hand side. You see quite a big spike down. That was a perfect storm, because it caught a lot of the banks who do the famous what's called carry trade. It's a technical term. It caught them out, and there was a great deal of angst that countries around the world were going to have to drop interest rates immediately just to counter this, and it didn't happen. It was a bit of an imperfect storm in a teacup. The teacup didn't break, it recovered, and you can see the line from that steep decline on the far right-hand side has pretty much recovered in a trajectory that it should have been going anyway. So yeah, from a global perspective, 3 major developed areas that are performing. A note doesn't have to outperform. We just got to remain where we kind of are, or we can degrade by 35% and we still get our money back and we enjoy the coupons. So the test done, as you can see, the bottom 2 lines. IDAT have done a lot of back testing on terms of, would there have been a breach? And they've done a lot of breach and a lot of testing, and 0 breaching of the capital protection barrier. So that's quite a comforting thought looking backwards. That's not to say, as they always say in financial terms, past performance is no indicator of future performance. But the trend, as they say in stockbroking, is your friend. And this certainly gives quite a lot of comfort to those clients who'd be considering this for their portfolio.
Andrew, thank you. So if everybody's good, are there any questions you'd like to ask on this particular note? Otherwise, we'll change gear and have a look at something a little different. Everybody good? All right. It is compulsory to please ask a question somewhere along the line. Nice. What about going back to 2008? Ray, good question. So if we come back and have a look at the graph, we don't get all the way back there. Andrew, do you want to comment on that? Here you can see the impact COVID had for that short period.
So 2008 was it's not on the chart, but 2008 was the advent of the so-called great financial service meltdown around the world. It started in the United States. If you remember, a few years before that, in 1999, 2000, we had the big scare that planes were going to fall out of the sky, computers were going to stop working, our lives were going to change. The so-called dot-com bubble was going to implode because programming had not taken into account various integers and numbers that had to go when we changed centuries. Anyway, that didn't happen. But in 2008, what had happened was pretty much globally, but specifically in the United States, but it was a global phenomenon. Banks had become very greedy in terms of their trying to make money for their clients, their shareholders, etc. And the compliance and guidance and oversight on banks had kind of lost sight of what that was. Anyway, what had happened was that banks were literally lending money against toxic assets. In other words, they were taking in assets, and they weren't very good assets. They didn't hold value. So in other words, just give you a very good example. A young couple walks into Fannie Mae or Fannie Mac, two of the biggest lenders in the United States. They'd say, we've got $100,000 to buy a house. And the bank would say, no, we'll give you $140,000. You can build your swimming pool. You can have a dock and your boat lined up. You'll buy all this good stuff now. And they thought, fantastic. And of course, obviously, against the assets which they were lending and putting into various structures were not holding value. They didn't have the right collateral. So when things started turning, interest rates and economies, the banks didn't have the money to back the loans, and the loans sank the banks. Probably the most famous one was Merrill Lynch, who went under. I beg your pardon, Lehman Brothers. They were probably one of the darlings of Wall Street, been going, for 100 years. And it went under. They were big advocates of those two former lenders. So yeah, that happened, and it spread around the world like a contagion, a bit like COVID. And you had banks collapsing all over the place. Iceland, the UK, Germany, everywhere, right across the world. So yeah, a little bit like a financial COVID. What it caused the world to do is actually reevaluate what banks are doing with our money. in terms of how they take it in and how they actually spend it and how they lend it out back again to us in some instances. And it has actually become quite a robust situation, and that's why Cashbox always looks at the underlying bank who's underwriting or guaranteeing a particular product. Those particular indices over the period were affected. I think they were pretty much affected like what happened in March 2020, and pretty much around the world, whether you're the S&P, the Dow Jones, the FTSE, everybody was in the same kind of basket, very much like what happened in 2020. But I think governance and the world, it's called, I suppose you can call it, paying your school fees, but it's not a good idea if you're paying your school fees and you decide to get out at the bottom, because then you're crystallizing a loss. So we often say at Cashbox, after you've done your due diligence on a particular note, after you've done your research, and it fits into your rules of where you want to go with your particular strategy, is to have that discipline. And this particular note is that it's a 3-year period. It's 36 months. You've got a guaranteed 7%. It's from a reputable A1 tier 1 A-rated bank. And yeah, I suppose, as one could say, the inevitability of somebody pushing a big red button somewhere, and we all fall into a sort of nuclear holocaust that would cause chaos around the world. There are too many variables to look at, and that's the noise that I call it the noise that we're confronted with on a daily basis through social media, through your press, through your internet, through whatever. I think we actually have to make some calls in terms of, this is what I want to do. This is what I can put at risk. This is what I've got to put behind the moat, the protection moat, and let's go forward. Because otherwise, time out of the market is that you will lose in the long term.
Great question, Ray. Thank you for that.
Thanks, Ray.
Yeah, Donatella, you mentioned it could mature earlier than 3 years. The next note that we're going to chat about has an auto call feature. This one is a fixed term, Donatella, fixed income and fixed term. So you are locking your money away for 3 years. So no auto call in this one. And then Connor, is it the worst of? Would you take the full loss of the worst performing index? So Connor, if one of the 3 shares drops below 65%, the full capital that we have will then be subject to what we call a 1-to-1 reduction, as if we owned the lowest performing share. So let's say one share closed out at 60% of its start price. In other words, it's dropped by 40%. We won't lose all our capital. We'll get 60% of our capital out, as if we owned that lowest performing share. So yes, this is why the back testing is so important. This is why us having a look at stability is so important. And again, as Andrew was saying, to generate the 7% per annum fixed, we don't need the indexes to even rise, as long as they don't drop by more than 35%, and you've got 3 years. So if you're looking at the graphs, theoretically, they're rising steadily each year. So I hope that answers your question, Connor. And Rajiv, how are you? Please explain why we have quarterly interest of 6 in pound and slightly higher in US dollars. Would the quarterly interest be paid combined? No. So Rajiv, you can either take this product in pounds or take this product in US dollars, and you would put your instruction to the bank in either currency. So you could either invest pounds or dollars into this product. They do pay slightly different rates. Andrew, if you could remind us why the US would get slightly more than pound sterling, if you don't mind.
Yeah, so this is just really a currency conversion, cross-currency swap, what they call them swap rates. In other words, if you just go to your local bank, let's say you're talking about, I'm not quite sure where you are, but let's say South Africa, you compare the rand versus the pound, the rand versus the dollar, rand versus euro, and you'll get a different differential each time. In other words, each of those currencies is different. One is stronger than the other, and that relates to some legacy issues in terms of economies. But typically, at this point in time, the dollar's fairly strong in terms of where it's at. Historically, if you look at it against the pound and the euro, you look at what world commodities are priced in, gold, oil, maize, etc. per ton. It's normally dollars per pound, per ounces, etc. But it has to do with essentially what's called interest swap rates. So the UK at the moment has got much lower interest rates than the US. The US is fairly high at the moment, and it relates also to your economic purchasing power of those economies. So it's really a currency. It's really a currency differentiator, and typically US dollars has paid a higher coupon rate. And Chad, you'll agree with this, since Cashbox started in 2019, we've never seen a pound sterling amount higher than dollars. It's always been dollars higher. And we have produced some euros, and those euros coupon rates are being closer to the dollar than the pound. So there's not a heck of a lot in them, but that it's a little bit like the exchange rate. You're going to pay slightly more for your dollar, hence you get a little bit more out, and you're going to pay for your pound.
Cool. Thank you guys for those questions. Are you ready to switch gears? We'll jump into the next product if that's good for you. While we saw a defined income product as the first product, now what we're looking at is a growth-based note. So in this particular case, you'll see that coupon is much higher. And what we're going to be looking at is a basket of underlying shares now, not indexes. And what that does is it starts to push up the coupon rate. This grows. So for each quarter that passes, 3.75 is going to get added to the pot until eventually this product auto calls. And to answer a previous question, this product can auto call. And we'll ask Andrew then to take us through the hows and whats and what we were thinking in this space.
Yeah, thanks, Chad. So there's the slide, and it's a first for Cashbox. This is the only slide that I'm going to talk to because I'm in the dark. We decided, do we throw a very similar presentation at the audience that we presented about 4 weeks ago, Chad, on exactly the same basket of indices. We produced a rationale, as we always do, which is really the reasoning of why we have chosen a banking theme with these particular companies and the underwriter to present to the investment community. The rationale is available, and what we presented 4 weeks ago is very much still in the space of it still resonates, it still makes sense, it's contextual. In fact, we had a launch in August last year and in December, and pretty much the narrative that pulls through all of these notes remains the same. And so we're not going to spend a huge amount of time showing the fate and fortunes of these companies. I'm rather going to talk to a few concerns that clients have had in terms of questions that I fielded in the last sort of 48 hours while I've been traveling. So if you read the rationale of the previous note, for example, we can drop that in and send it to you. If you haven't seen it before, it deals in great depth as to why this is a good defensive sector to be in at the moment. If you think about why we are showcasing two notes, it goes to some of our sort of DNA in terms of we're looking currently at what resonates in the world. There's a lot of uncertainty. There are a lot of headwinds. What I mean by that, there's geopolitical headwinds that I've mentioned, wars and conflicts. There's a new US administration which seems to be turning the world on its head at every executive order that gets pushed out on a daily basis. There's stresses and strains. There's interest rates. There's inflation. There's a lot of things beyond our control. But the one thing we can control within choosing and selecting the right note to augment our portfolios and to build into our portfolios is defensive sectors. Now, banking is generally a very boring sector. It's not like tech where you've got 500% returns every 3 days or something. I'm making light of it, but it's tech is a sexy sector. It gets in the headlights. It's on everybody's lips. Banking is like bit boring, but it's like a super tanker versus the tech speedboat. But the super tanker has done phenomenally well and this is one of the concerns that has been brought up recently, to the degree that can banking, which has done extraordinarily well, particularly last year with high interest rates, even though they were coming down, especially in Europe. And you'll notice there, 3 of those banks are European banks, and only Morgan Stanley is a US-based bank. Okay, put it this way: they're all global. They have revenues coming in from global, all 4 points of the compass. They are global investment banks, but they are based in a particular jurisdiction. 3 of them in Europe, 1 in the United States. Now, there's a reason for that, and I've dealt with it in some detail in the rationale, but I'll just cut to a quick sort of takeaway, Pricey. We feel that certainly Europe offers a more stable environment in terms of they are committed to dropping interest rates, which should boost their economy. Their economy is way less active than the US. The US is resilient, it's robust, it's still making lots of money for lots of people. Europe has been is a little bit stagnant, so they're having to drop rates to get it moving. Okay. But the assets that these banks hold are very, very good. And the analysts and the analysts feel that the quality of assets that these banks hold is very good. And even with the declining interest rates, that should also help the banks, obviously, with their impairments. So obviously, if you're carrying debt and you're carrying debt for too long, eventually you run out of lifeline and you go out of business. But the banks can identify that, and especially when it's dropping rates, they can actually manage that through. What it does do for the bank is it obviously drops their the interest that they're making on the debt that we're paying, okay, people in the street. High interest rates, we all sort of close our wallets and hope for the best and try and service our debt. As they come down, consumerism will start coming to the fore. People have a little bit more disposable and discretionary spending ability, and those other sectors, discretionary spending, staples, etc., will start taking off. But the real area where these banks are going to supplement revenue, which will flow through to earnings and profit, is that there's a great, and it started in 2024, there's a great thrust in terms of consolidation, if I can use that word. Now, what I mean by that is that in the banking sector, which is this boring kind of sector, a lot of the banks are either coming together, they're being forced together, or they're being taken over. So a lot of mergers and acquisitions. So there's a lot of corporate activity going on in these banks. UniCredit, for example, their boss, who was the banker of the year in Europe last year, he's been designated the global shark of finance because he's got some very big plans to take over a number of European banks currently on the go at the moment, which will lead the second biggest bank in Italy to becoming the third biggest bank in Europe. So major, major moves. So a lot of that activity will generate massive fees and offset perhaps the declining interest rate margins with falling interest rates. So we're comfortable from a perspective of, if I can call it, swings and roundabouts, that whilst you might be losing in terms of some of the very high interest rates that banks have enjoyed, because they enjoy obviously that, there's going to be a lot of activity, and it started last year. Commerzbank is involved in it, BBVA is involved with it, Morgan Stanley not so much. So there's a 75% weighting towards European banks. The European banking sector has a very what's called low price earnings multiple. In other words, they are relatively cheaply valued in terms of their peer group, let's say in America or in the UK. So that's why we've have a preponderance of European banks, and we've detailed that in some detail in the rationale. I think I did an investigation into a number of these banks today on a question of are there stellar returns of 2024 going to continue this year? And quite frankly, out of 36 analysts, analytical consensus, the consensus out of 36 analysts, I beg your pardon, is that earnings are going to dip this year, definitely. The earnings are going to dip. There's threats of tariffs, which will affect businesses, and businesses bank with banks. Okay, so some of their earnings, they might not want to do certain things, and they might put things on hold, etc. So effectively, there will be some effect on ultimately the bank's earnings and fees, which flow through to profits, and that's what's the most important thing to a shareholder, because the bank will obviously get profits back. if hopefully, not just on their valuation in terms of the price of the share. So if one looks at this activity that I've been talking about in terms of mergers and acquisitions, corporate takeovers, there's lots of fees that are becoming through. But there is this general backdrop of it's going to be a tougher environment, not from interest rates, but in terms of maybe economic pressures from the States, from Euroland, etc. The consensus is, though, that most of these European banks are still fair value in terms of what they should be valued at the moment, dependent on certain things happening. So again, analysts like economists, they can change their mind, I guess, every 5 seconds, and they wake up in the morning, they'll change their minds. But a lot of work goes into this, and I have been sharing with 1 or 2 clients some detailed studies in terms of what goes into Cashbox, including a BBVA or a UniCredit or Morgan Stanley, warts and all, in terms of it's a very much deep dive under the hood. And if anybody would like to, if I'd like to share that with you, please let me know. But it literally says, what makes this narrative worthwhile to look at? Does it make sense in this particular note? What are the problems that this particular bank, one of those underlying banks, is facing? What are the opportunities? What's the outcome, the consensual outcome? And quite comfortably, if I look across the 36 analysts of Wall Street, these are all holds or buys. It's not sells at the moment. And as I mentioned per the earlier note, and in fact, it's for all our notes, we don't have to outperform. This particular note has got additional protection bought in versus the note that we just closed. It was oversubscribed. It was exactly the same note that finished a couple of weeks ago. It was exactly the same note in terms of the underlying constituent reference companies, BBVA, UniCredit, Morgans, and Commerzbank. Nothing has changed there. So we haven't said like, oh, we've got a major problem with one of the banks now. We've looked at it. It still makes sense. It's still contextual. It still has reference. And that's something that, again, I'll mention. I said, if you've done your homework and you've done your due diligence, stay the course. We've stayed the course with this. We believe, in as much as a year ago, this was the right area to be in, and we launched 3 notes in that space. We still believe for the next 12 to 24 months, this is a really good space to be in terms of the hard facts that are coming out through analysts. And I think where we have made a difference is that with this particular note, we've given up 2%, okay? The last note had a 17% coupon. We've given up 2% to the bank to build an extra protection, okay? And Chad's going to take you through that. And I think that's really the crux of this particular note, is that how do we differentiate this note at 15% from the note that was oversubscribed at 17%? And it's a note for its times in terms of there are unsettled times coming. We don't know. They might settle or they might be unsettled. But let's rather take that extra insurance, give up 2%, and build in another layer of protection. But like an onion, you just keep building up those layers and layers and layers, and we're in the middle. So I think, Chad, jump into your explanation of how we're going to protect clients.
All right. Thanks, Andrew. Always interesting. So again, in terms of the terms, the issuing bank, Société Générale, highly rated, top of the pops. The growth coupon in this case is set at 15% per annum. It's based in USD. Our previous note you could take in either USD or GBP. That was the income note. This growth-based note is just USD. As each quarter passes, 3.75% of the capital that you've invested gets added into a growth coupon to be paid out at AUTOCALL. I'll explain that in a second. The term is a maximum of 4 years, so it is likely that this product is going to mature early. So the previous bank's notes we have done have matured in 6 months, 9 months, and a couple in a year, just depending on where they're at. And as Andrew said, we don't need these products to shoot the lights out. If they just stay at their start price, or even if they dip by 5%, the first observation that we can possibly AUTOCALL at is already from 6 months, and then every quarter thereafter. 2 extra pieces of protection will be built in. There's a low hurdle, meaning that at the last observation, if we haven't yet auto-called, the auto-call level is going to drop from 95% right the way to 70%. I'll show you in a graph just now. So pictorially we can see it, or graphically we can see it. So the auto-call level is even easier if we get to that level or that duration. The reference basket of the banks Andrew spoke of, and then of course the capital protection. Our capital is protected by Societe Generale through the life of the product. Only at the very last observation, again, we need these shares, and we're talking about world's biggest banks, need to be above 50% of their start price. It's a huge drop. Then, if that is the case, and we do breach below 50%, the next level of protection is built in called a basket star. This is new to all of us. I really like this idea. I'm going to explain it a little bit further down by way of numbers. And what's wonderful here, to I think Connor's earlier question, if we get to this level, the shares are combined and then the average is taken, and we want that to be above 80%. But give us a minute, I'll explain that. The availability for this guy is 26th of February, or by full subscription. As Andrew said, our previous note was fully subscribed. In this case, it's a US denominated product at $10,000. So looking at this graphically now, a structured note runs per quarter. There's a typo in the top here, folks. 3.75 should remain the same for the period. I beg your pardon. And this should be 15% as a total. I do beg your pardon. So quarter one, nothing will happen. We're sitting tight. Quarter two, as quarter one passes, 3.75% is put aside by the bank, waiting for an auto call. If at quarter two, the underlying banks, the share value of those is above 95% of their start price, we'd already be in the money and the product would auto call early. If that was the case, this is where we would get our full capital out and 15%. But should they carry on for a little longer, maybe one or two of the shares have dropped for whatever reason, and come back, as our graph has suggested, in quarter four, they don't all have to be above their start price 100%, but they all have to be above 95%. So in that case, the product then auto calls, the bank looks back at how many quarters have passed. We would then multiply the coupon rate times the quarters. That's the lump sum it's going to pay out. And as you know, folks, your trading account would then receive your capital and the coupon back probably within a week of auto call, and off we go, have a look at a new product. Now, if it is that any one of these shares is below the 95% and we don't auto call and we get to our very last observation, this is where that low hurdle comes in. Can you see we're in the money at 95%, the green area? The green area drops all the way down to 70%. So even if the lowest share is at or above 70% of its start price, bang, it'll be the full period's coupons and our capital paying out. What we then do, you saw from the terms and conditions, the capital protection in this case is set at 50%. So if we go back here and have a look, our capital is fully protected all the way until the last observation. We need the share to be above 50% in order to get our full capital back. If it drops below 50%, this is where Andrew and the team have built in the third level of protection. So let's have a look at that. What I've done is a screenshot of the very last observation should we get there. Level 1, we would obviously get the multiple of coupons out plus all our capital. If we landed in this area of no man's land and we were below 70% but above 50%, very deep level of protection, we'd get our capital out. Not a great outcome. It's not what we want. We want to auto call before so we can get our capital and the coupons. So two's not great, but it's a lot of protection built in that if in the unlikely event we get to this level, our capital is protected. Where else can you get to invest in banks with this level of protection, right? Then what happens if we breach the 50%? In the unlikely event that we breach this, this basket star is going to kick in. How does that work? This is new to everybody, so I hope this is interesting. What's done then is the value of share 1, share 2, share 3, 4 are added together and an average is taken. And let's say share 4 is at 40%. But if we take the average is sitting at 90%. We're above the 80%. Our capital is not at risk. Our capital is paid back. So a wonderful area in case we get any one share that misbehaves. This is such a nice feature. I wish we'd seen them before. And Andrew, maybe I certainly think it's worth the 2% for this level of protection. So I hope this makes sense. So we're going to just go back one more time. We need the product to AUTOCALL to be in the green area to get all our coupons to flow. We want to do this ideally before the last observation. If at the last observation we do need this extra protection, there it is, another 30% or just under, sorry. Or 2, we'll end up in no man's land. Our capital is protected, it comes back, but no coupon. Don't really want that. And then 3, if we go below this, there's a multiple to understand as long as we're above the 80%. If we do fall below 80%, then like our previous conversation, we'd get our capital out based on the lowest performing. So let's say in this case, it was at 45%. Any one of the shares, we would get 45% of our capital out. So in this case, we now got observations starting at 6 months and payment roughly a week thereafter to your trading account. No funds ever flow through Cashbox. It's directly between you and your trading account. This keeps the fees light, administration light. It's wonderful. And if we're above 95%, the AUTOCALL will kick in. That 95% remains the same through every single quarter until the very last observation. You see it drops to 70%. That's our low hurdle. And then if we do breach that again, we'll then go into the basket star. Andrew, I really like this. So folks, we need to be comfortable, with the strength of the bank. You're contracting with the bank. You're loaning money to the bank, which is a very different concept, right? They're going to give you a contract in return. That contract is the fact sheet. Please make sure you understand it. Please make sure you're comfortable with all those underlying terms and conditions. And then, of course, are you comfortable that the underlying stocks are not likely to drop below those capital protection barriers so that we don't impact capital? Andrew, I think between the two, there's a wonderful mix for anybody's portfolio. Well done. So for those that might be new to Cashbox, we love doing training. We'd love you to reach out if you wanted extra training to understand this a bit more, with pleasure. You need an online trading platform. This is a custodial platform, it's called, because they're going to hold custody of your contract. Yes, they're online stockbrokers, and we only deal with the top ones in the world because the top investment banks would only deal with the top trading platforms, of course. If you're interested, please email us or give us a call. We'll then issue you with the ISIN number. This is the International Securities Identification Number, and this gets you straight into the product. There will be a different one for either product, and there'll be a different one in the fixed income between pound and dollar. So there are 3 if you need. Reporting, we come back to you, we let you know how the product's doing every quarter in terms of observations, and Andrew does a commentary. It's really interesting to watch. Ongoing refresher training and the likes. And there's our email address, everybody. I'll drop it into the chat again if you want to copy it. That's support@cashbox.global. And we'd love to hear from you. I'm going to open up for questions now. Ray, yes, with pleasure, we can help you. That's wonderful, no problem. Did everybody get and understand A, the low hurdle, and B, our new opportunity in terms of protection, our basket star? Any questions on that front? Well done.
Chad, I think if I can just add one thing.
Yep.
I had a chat with a client this afternoon who was struggling to understand this new concept. Yep. And eventually when they got it, they are English, and they used a very English sense of terminology, and they said, "Oh, it's a bit like more belts and braces for my protection." I said, "Well, exactly. It's a little bit more. You've had to give up a little bit," because they were keen on the 17%. And I said, but things have changed. The market, the banks have run quite hot, so we're just being a little more prudent. There's a concept of where's the smart money moving, where's the sage money, and in as much as we can put a lot of money into exciting stuff, digital assets, Bitcoin, tech, etc. A lot of the protection that this particular note has built in with the contract carries a lot of weight. It does, yeah.
Well done. Chetan, if you've got a sec, how's the take-up been your side? What's your feeling?
So far, it's been quite good. It's been taken up quite well. This new basket star seems to be a winner. So, we've seen this for the first time. So I think it's quite a good feature having it into this node, especially with the banks. But the people having a little bit doubt with the banks, this is a good feature to have. I think
good. Well, folks, thank you very much. We've hit the hour. Oh, Connor, good question. Are the notes priced daily for reporting? Yes, so you would get reports on your trading account. You'd understand where we are. It can be a little bit misleading, Connor, and I'll tell you why. We actually own a contract with terms and conditions in it. And then when the bank does price, they have a look at the underlying shares, and that then produces a value. So while we're waiting for a product to auto-call, you'll typically see that the contract looks like it's lost money. But you need to understand we're in with all those terms and conditions, which a trading account can't see. They only see the underlying shares. So it's always a question. Why? It looks like this thing has lost value. It will until it auto-calls. And then once it's auto-called, it's going to be cleared off my account. The cash will then be sitting in my trading account. But good question, Connor. Have I answered it?
I think, Chad, if I can just add something in there as well,
Sure.
because that's a question I field regularly. The bank, the reporting platform, or the bank, whoever you're dealing through, the stockbroker, is legally obliged to report, to price the contract daily. So at the close of business, let's say, for example, we've got three banks in the Euroland area. We've got one bank in America. So at close of business on those various stock exchanges in Europe, there's a closing price of the bank, and the same would happen a few hours later in New York for Morgan Stanley. They're obliged to actually price those up, and they price them up as if you owned those shares. Now, as we go to great lengths, you don't own those shares, but legally they have to give some sort of value, and they do that simply because if you woke up one morning and said, "Look, I've had enough. I want to sell my structured note and get out," they'd have to somehow price it. So they price it on the basis of you breaking the contract. So they price it as if you actually owned the shares, which you actually really don't, and they'd apply that percentage to the amount of money you had invested. Now, we get some situations, I'll give you an example, where for much of the quarter that's under observation, let's say you're halfway through a particular reporting quarter, all four companies are well above their thresholds for autocall, for example, okay? And the bank actually says, well, we'll pay you a premium to get out. And that's when you can actually trade a note. But it doesn't often happen, but you can see it. So, for example, you might have four particular stocks or four indices that are running very hot. They're well above their observation date before the observation date, and you'll see your daily pricing will be well above what you invested. It might say, the current price is 125% or 118% of nominal, which was what you invested. And so that's a completely different strategy. But that's why they've got to do it legally, very much like an ETF or a mutual fund or a unit trust. They have to price it. And for a structured note perspective, they have to price it as if you own the shares. But bearing in mind, we don't own the shares, we don't get dividends from them. It's just a reference story that we're aligned to.
Great question, Connor. Thank you. Anybody else? Cool. Andrew, thanks for taking time out